Understanding stocks and bonds, beginners. Understanding financial statements for investing. Investment audiobook. From How to Invest Money. By George G. Henry. Updated edition. Please note, this audiobook is provided for entertainment purposes only. Before making any investment, you should seek independent advice from a professional. Chapter 1. The importance of investment. With the immense increase in global wealth during the last decade, the problem of investment has assumed increasingly greater importance. The number of people today in possession of funds in excess of their private needs and business requirements is far greater now than ever before, and these needs and requirements are constantly increasing. So, if this applies to you, you are confronted with a real investment problem. While you may not recognize it, the problem that you need to solve is twofold. You need to protect the funds you already have, as well as invest any excess funds wisely. It's easy to solve the first part of this problem, but the second problem, investing, is far more difficult. It's obviously a lost opportunity to have any surplus money that you have in bank accounts these days, with the poor interest rates being offered by financial institutions. More than that, there is always the constant temptation to dip into these funds and deplete them. Confronted with this double problem, what steps can be taken toward a solution? It is safe to say that many people find it easier to make money than to take care of it. After all, money-making is the result of successful activity in your own line of work, which is usually familiar to you. On the other hand, the investment of money may be something new to you, with which you may have little practical experience. Well, that's where this brief audiobook can help. Chapter 2. 5 Basic Principles of Investing. Making good decisions about how to invest your money involves 5 basic principles. 1. The safety of the amount invested. In other words, the potential for loss. 2. The net return or income that can be made on the money invested. 3. Convertibility into cash, or how easy it is to cash in your investment. 4. Prospect of appreciation in value, or the growth in value which increases the market price. And 5. The stability of the market. These 5 qualities are present in different degrees in every investment, and the wise investor needs to take them into account. And invariably, when one of the 5 things on the list is positive, others will certainly be negative. For instance, on the point of safety, there's a big difference between the safety of your original investment and the safety of any potential income. In addition, the stability of the market can vary wildly from time to time. An investment may be safe in terms of the original investment and potential earnings, but yet suffer a violent decline in market price, because of a change in general economic and financial conditions. In times of business prosperity, very high rates can be earned on investment because the liquid capital of the country, to a large extent, will be converted into new forms of economic development. With these comments, in a brief and imperfect way, I'm trying to indicate the main points that should be considered in the selection of your investments. I will show further examples of these points in the remainder of the book. For now, the key point here is that you need to have a thorough understanding of your needs and goals before you attempt to make any investment. Of course, for many people, the safety of your original investment should give you pause for thought. And of course, any investment is bound to involve risk and a market that may become volatile at some point in the future. So if you need to be able to access your money quickly, then safety and convertibility may be the most important points for you. Conversely, if you are able to lock down your money longer term, you may want to consider investments that are riskier over the short term, but may gain greater income over the longer term. So, the biggest problem now is knowing which investment to choose. Chapter 3. Stocks. Please note that this chapter applies to stocks of companies that predominantly have a physical presence. If you are considering investing in an online or digital business, please skip to the next chapter. When considering stocks as investments, you first need to know the difference between stocks and bonds. The distinction between bonds and stocks between promises to pay and equities. Bonds, whether they are corporate or municipal, and real estate mortgages represent someone's promise to repay a sum of money in the future. If the promise is valid and the security sound, the holder of the bond will be paid money on the date due. Stocks, on the other hand, represent only a fractional interest or share in the assets and profits of a company, after payment of its obligations and fixed charges. When you buy stock, you become a partner in a business enterprise, exercising a proportionate share in the direction of the company's affairs by casting a vote at company meetings, and sharing ratably in its profits and losses. The value of the share you acquire may be large or small, and may increase or diminish. However, in no case can the holder of shares require anyone, least of all the company itself, to take their share off their hands at the price they paid for it, or, indeed, at any price if the market has a downturn. On the other hand, if you buy a $1,000 bond, you know that the payee, if they are still solvent, will pay you $1,000 in cash when the bond matures, plus a quantity of interest. When you buy a bond, you essentially become a creditor of the company, although without a voice in its management. Nevertheless, you are entitled to receive your principal and interest when due. If the payee does not fulfill this obligation, the company will have to hand over the bond to a trustee to ensure payment. In the one case, you buy a promise to pay, and in the other, an equity or share of a business enterprise. One class of stocks deserves special mention. Bank and trust company stocks possess one characteristic in higher degree than other classes of stock. Owing to the general practice of self-regulated banking institutions to distribute only about one-half their earnings in dividends and to credit the rest to the surplus account, a steady rise is assured in the book value of the bank stock. No other class of stock possesses quite the same promise of appreciation in value. For this reason, bank and trust company stocks can become sought after at certain times by those who can forego something in the way of income return for the sake of increasing the growth of their investment. The general characteristics of bank stocks are greater safety and practical certainty of appreciation in value, but a lower rate of income and limited convertibility. So with these comments, I bring the present chapter to an end. The next chapters will discuss two different types of bonds. Finally, I will explain the general principles which control the market movements of all negotiable stocks or securities, and will endeavor to point out the indications which may be relied upon in determining whether given conditions are favorable for the purchase of these securities. Chapter 4. Corporate bonds and understanding financial statements. Corporate bonds are the obligations of business enterprises and form a class quite distinct from other types of bonds. Consideration 1. The safety of corporate bonds. The safety of corporate bonds, in common with the safety of all forms of investment, depends upon the increase in the value of the investment in excess of the amount invested. In the case of corporate bonds, the amount of this excess or margin is not always easy to determine. And even when determined, the rule is difficult to apply because a margin that may seem poor from the point of view of the physical valuation of a company may be excellent when considering the investment potential of the security. The factors that can be most relied upon in estimating the safety of corporate bonds are as follows. Factor 1. The value of real estate. One point to be determined in considering the purchase of a corporate bond is the value of its real estate. If the appraised value of the ground, irrespective of the buildings and machinery upon it, is greater by a substantial sum than the amount of the bond issue, the obligation is practically being used by the company as a mortgage. In such a case, while what can be earned on the bond may be low, the safety of the bond can hardly be questioned. In judging a bond upon its real estate value, it's not always safe to take the cost price of the land as shown by the company's financial statements, because frequently the cost can be adjusted by various accounting methods. So judgment should be based upon the appraised value of the land. If the bond meets this test, as prospective investor, you may feel reasonably sure that the safety of your principal is not in question, and may buy the bond without anxiety if it satisfies your other requirements for liquidity and so on. On the other hand, if the bond only partially meets the real estate value test, and it appears that some part of its value comes from property and equipment and from the strength of the company as a business enterprise, then it's necessary for the investor to consider other factors. Factor 2. Net liquid assets. The balance sheet of the financial statements of every corporate company can be divided into two parts. Its assets are of two kinds: property assets, which are fixed, and current assets, which are fluid. Similarly, its liabilities are of two kinds: capital liabilities and current liabilities. Plant and property assets are usually lumped together under the heading, cost of property. Current assets include inventories, bills and accounts receivable, agents' balances, marketable securities, and cash on hand and in banks. Everything, in short, which can be quickly converted into cash. On the other side of the balance sheet, capital liabilities are easily determined. They consist of the par or issue value of bonds and stocks outstanding. Current liabilities comprise bills and accounts payable, including borrowed money, payroll costs, interest and taxes. The real strength of every corporate entity can be gleaned from the figures relating to its current accounts. Property assets and capital liabilities are not of the same significance. If the cost of plant and equipment as shown by the books exceeds its real value, the market usually makes the necessary adjustment by putting a price, less than par, upon the bonds and stocks. In the case of the current accounts, no such process is possible. If the current liabilities exceed the current assets, the company shows a deficit, whatever its surplus may show on the books. On the other hand, if the current assets are greater than the current liabilities, the company possesses a working capital, represented by the difference between the two figures, and known as net quick assets. There are three things to consider in connection with net quick assets. First, the proportion between current assets and current liabilities. To put a company in good shape, its current assets should be at least twice as great as its current liabilities. 2-for-1 is a fair proportion, although some companies can show as much as 6-to-1 or even better. The stronger a company is in this proportion, the better. Secondly, the proportion between net quick assets and bonded debt should be considered. The bonded debt should never exceed net quick assets, except when the company possesses real estate, in which case, 2/3 of the real estate value plus the net quick assets should cover the bonds. Some companies even do much better than that. Thirdly, the proportion between net quick assets and the surplus shown in the balance sheet should be considered. If the capital liabilities exactly balance the property assets, then the surplus will exactly balance the net quick assets. If the surplus is smaller than net quick assets, it is usually a sign that capital liabilities have been created to provide working capital. Opinions differ as to the wisdom of this course of action. Generally speaking, it is better for a company to provide working capital by means of a stock issue than to depend upon banks for funding. The exception to this rule occurs in the case of companies that require a great deal of working capital for part of the year and only a little at other times. If they have the best banking connections, such companies may be safe in depending upon their banks to carry them, but if they do so, they should have no bonded or other fixed indebtedness which would prevent these debts forming a lien upon their other assets. If working capital is to be created by the issue of capital liabilities, it is much better that it should be done by stocks than by bonds. However, the ideal method is to provide only such an amount of working capital at the organization of a company as is necessary for the conduct of its business, and then, as the volume of its business grows, to accumulate the additional amount necessary out of earnings, refraining from the payment of dividends until the fund is complete. Before leaving the subject of net quick assets, it's good to note the importance of the figure showing the actual amount of current liabilities. If a company has outstanding large amounts of accounts payable, it's in a vulnerable position. The inability to renew maturing debts can be a cause of corporate failure. Factor 3. Net earnings. The amount of net earnings is of great importance in estimating the strength of any corporate entity. The figures for a number of years should be examined to determine whether the earnings are increasing or decreasing, and to discover whether or not the earning power of the company is stable. This will depend largely upon the nature of the business that the company engages in. If it enjoys a steady demand at a uniform income stream for what it offers, it is justifiable that some of its capital could be in the form of debt. But if its earnings fluctuate due to rapid changes in the price of its service or product, there is little justification for conducting the business on borrowed money. In this connection, it should always be considered how greatly a falling off in gross earnings will affect net earnings. And the proportion between net earnings and fixed charges should be carefully noted. In order for a corporate bond to receive favorable consideration, the average yearly net earnings of the company should amount to about 3 times the annual bond interest, taxes, and reserves. The greater the protection in this respect, the better. Factor 4. Form of issue. The form in which a corporate bond is issued is very important. If the repayment of the face amount of the bond isn't due for a number of years, there is danger that the property will depreciate and leave the bond without sufficient protection. There are 2 ways to overcome this difficulty. One way is to establish a sinking fund which will retire a certain proportion of the bonds each year. Another way is to issue the bonds in serial form, with a definite installment maturing every year. In either case, the annual sinking fund or annual installment should be greater than the probable depreciation, so that the margin of security will be constantly increasing. Factor 5. Management and control. No question is of greater importance in estimating the strength of a corporate entity than the reputation of the people in charge. The ability and integrity of the people who control the policy of the company and the efficiency of the operating officials are the principal factors in the success of a corporate undertaking. Changing policies, weakly executed, will ruin the most promising business enterprise. This is particularly true in the case of small companies. Every person of business experience will understand the importance of this factor and should be guided by it in the selection of corporate securities. Based upon the foregoing considerations, it is of interest to inquire what degree of safety there really is in the average corporate bond. How far does a bond meet the foregoing requirements? This question is difficult to answer. Corporate bonds vary greatly in point of safety, some issues possessing great strength and others being highly speculative. No general conclusions can be drawn, so as an investor, you are forced to consider each bond issue upon its own merits. Consideration 2. Rate of income. The average net return upon corporate bonds is probably higher than upon any other form of funded corporate obligation. This constitutes one of the chief advantages of corporate bonds. Consideration 3. Convertibility. It is impossible to make any general statement in regard to the convertibility of corporate bonds. Some corporate bonds, notably the larger issues of well-known entities, command a broad and active market. Such bonds can be sold in large amounts at almost any time without seriously affecting the price. On the other hand, the obligations of smaller companies can be almost as unmarketable. Between these 2 extremes, all varieties of corporate bonds can be found. The degree of convertibility that a security possesses is usually a matter of some importance, so as an investor, you should make a careful examination of each bond in this respect. Consideration 4. Prospect of appreciation in value. The improvement in security during the time that an investor holds a bond is of little importance, unless the improvement is reflected in the market price of the bond. In this way, the investor takes advantage of its appreciation in value. In order for the improvement in security to be reflected in market price, and thus add to the principal invested, it is necessary that a bond should possess a fairly active market. For this reason, corporate bonds that hold out the greatest promise of appreciation in value are the larger, more speculative issues, which possess the greatest convertibility. The purchase of such bonds can frequently result in substantial profits. Consideration 5. Stability of market price. The 4 points above touched upon, safety, rate of income, convertibility, and the likelihood of improvement in intrinsic value, are all inherent characteristics of every bond. The likelihood of favorable or unfavorable fluctuations in market price are largely external in nature, and depend upon general financial and business conditions. As a class of assets, corporate bonds cannot be said to possess much stability of market price. Some of the smaller issues enjoy a fictitious stability because of their inactivity, but generally speaking, corporate bonds are subject to wide fluctuations in accordance with changes in the business outlook. The foregoing is a summary, necessarily brief and imperfect, of the main points to be considered in judging the value of corporate bonds, based upon a financial statement analysis. The question remains whether such securities are desirable for the investment of a business surplus and of private funds. Except in special cases, corporate bonds are not suitable for a business surplus. It's impossible to find a corporate bond that combines all the requirements necessary for that purpose, the requirements being great safety of principal and interest, a relatively high return, ready convertibility, and stability of the market price. Many corporate bonds can be found which combine two of these requirements, some even which combine three, but the full combination, if it exists at all, is unknown to me personally. For private investment, the case is somewhat different. A person of good business judgment, who desires to obtain a high yield for which they are prepared to sacrifice something in the way of convertibility and prospect of appreciation in value, may buy the underlying issues of strong companies with every confidence in the safety of their principal. Again, the investor who wants high yield and quick convertibility, who is prepared to take a business person's risk and to sacrifice stability of market price, may make a large profit by buying second-grade corporate bonds. However, no investor should deceive themselves with the idea that any corporate bond will satisfy all the requirements of the ideal investment. Chapter 5. Government bonds. Bonds issued by a national government, by a state, or by a municipality, are based primarily on some form of the power of taxation, although the bonds are usually tax-exempt within the political unit that creates them. When the power of taxation is unlimited, as in the case of the national government and each of the United States, there is usually little doubt about the ability of the political unit to meet its obligation. It is probable that the obligations of the United States and United Kingdom governments, by reason of the fact that the wealth of the countries is so great and the good faith of the national people so clearly established, represent two of the highest types of security to be found in the world. Therefore, it is possible that United States Treasury bonds and United Kingdom government bonds can sell at a relatively higher price than the obligations of other countries, but it cannot be denied that the chief reason which causes them to sometimes sell at a higher price is the fact that they are often required by national banks as security. This fact is doubtless the controlling element in their market position, and accounts for their special strength. Only less secure than United States and United Kingdom bonds are the obligations of state governments. State bonds usually sell on a basis which may be taken as the equivalent of pure interest, with no element of risk or speculation involved. The obligations of different states sell at different prices, in accordance with market conditions and the relations of supply and demand, but there can be little question of the equal ability of all states to pay their obligations. Repudiation of state debts has occurred in history, but only in cases where an overwhelming majority of the citizens were opposed to the creation of the debt at the time of its issue and lacked the means to control the situation. Municipal bonds, in other words, the bonds of cities, counties, and townships, are indirectly a first lien upon all taxable property in the municipality, and take precedence of every form of mortgage or judgment lien. This lien is enforced through a tax levy to meet interest and principal, and because of this tax, the courts will compel payment in the rare cases in which a municipality attempts to repudiate a valid bond. This priority of the tax lien is the foundation of the prime position of municipal bonds. The case rarely occurs where a bond held valid by the courts is uncollectible if sufficient taxing power existed when the bond was issued to provide for its redemption. It is only when the municipality itself diminishes in population and taxable property to a vanishing point, that such a default can occur. We have seen such defaults occur recently in cities both in the United States and the United Kingdom. Investors can judge for themselves as to the likelihood of such a catastrophe in any particular community, and can feel sure that their bond, if valid and protected by a sufficient taxing power, is as secure in its principal and interest as the municipality which issues it is secure in its continued existence. The following are the chief points which should be considered in the investigation of a municipal bond. 1. The proportion which the total debt of the municipality bears to the assessed valuation of the property subject to taxation. Usually, a maximum rate is fixed by constitutional provision. 2. The purpose of issue. This must be a proper and suitable purpose. 3. The proceedings under which the bonds were issued. These proceedings, the form of bonds, their execution, and their legal details must be in full compliance with the law. If these points are found to be satisfactory, the investor can usually be assured that their bond ranks upon a substantial equality with government and state obligations. The rate of income to be derived from investment in municipal bonds varies in accordance with the obligations selected. Like other forms of security, municipal bonds are controlled by market conditions, and their price is determined by the relations of supply and demand, and by adjustment to prevailing money rates. While differing only moderately from one another in point of safety and income return, municipal bonds may be divided into two distinct classes in accordance with the degree of convertibility which they possess. Some municipal bonds possess great convertibility. Others almost none. The feature which chiefly determines the activity or inactivity of a municipal issue is the size and importance of the municipality, together with the amount of bonds which it has outstanding. The bonds of large and important cities, whose outstanding debt reaches considerable proportions, usually possess great activity. They are constantly traded and command a broad market because dealers are willing to buy or sell them in blocks. On the other hand, the bonds of counties, townships, and small cities are usually quite inactive. Transactions rarely occur in them, dealers do not make a market in them, and they can be sold only to genuine investors. It is often impossible even to have them quoted. But we are chiefly concerned in these pages with the advantages and disadvantages of different forms of investment from the point of view of the average person, both for the investment of their business income and of their private funds. So we need to ask whether municipal bonds, either active or inactive, conform to the requirements of the average business. It cannot be said that they do. Municipal bonds possess either convertibility without stability of price, or stability of price without convertibility. Both qualities are necessary for business purposes. The only form of municipal security which is at all adapted for the investment of a business surplus is a short-term issue of an active municipal bond. If it has only a very few years to run, its approach to maturity will mean that it has the necessary stability of price. But even in this case, equal safety and equal stability of price combined with a higher yield can probably be found in certain stocks. For private investment, the case is somewhat different. Enough has been said in the preceding chapters to impress upon the listener the importance of buying securities only in accordance with their needs and goals. If any investor, after careful comparison of the characteristics of municipal bonds with their needs, decides that they can more closely satisfy their requirements with municipals than with any other form of security, they should not hesitate to purchase them. Chapter 6. Judging the market movements of securities. An economic analysis. No question connected with the investment of money is more important than the ability to judge whether general market conditions are favorable for the purchase of securities. After learning how to judge the value of every form of investment, a person may still be unsuccessful in the investment of money, unless they acquire a firm grasp of the general principles which control the price movements of securities. By this, it is not meant that a person needs to have an intimate knowledge of technical market conditions whereby to estimate temporary fluctuations of minor importance, but rather that they should have in mind the causes which operate to produce the larger swings of prices. If you acquire such knowledge as an investor, you will be enabled to take advantage of large price movements in such a way as materially to increase your income, and at the same time, avoid holding securities which may have cost much more than their current market quotations. This is where we need to consider the well-known investing mantra. Buy low, sell high. What this means is that, if you can recognize the indications which point to the beginning of a pronounced upward swing in securities, and if you can equally recognize the signs which indicate that the movement has come to an end, you can liquidate the securities that you bought and make money. It is not expected, of course, that the average person will be able to realize this ideal of investment completely, but it is hoped that the following analysis will give you a clearer idea of the principles involved. Broadly speaking, the market movements of all negotiable securities are controlled by two influences, sometimes acting in opposition to each other and sometimes acting together. One of these influences is the loaning rate of free capital. The other is the general condition of business. A low market rate of interest, or the likelihood of low rates, has the effect of stimulating security prices, because banks and other money-lending institutions are forced into the investment market when they cannot loan money to any great advantage. Conversely, a high rate of interest, or the prospect of high rates, has the effect of depressing prices, because banking institutions sell their securities in order to lend this money to their customers. The automatic working of this process tends to produce a constant adjustment between the yields upon stocks and bonds. When money rates are low, securities tend to advance to the point where the return upon them is no greater than that derived from loaning the money. When rates are high, securities tend to decline to a point where the return is as great. This explains the influence of the first factor. The other factor is the general condition of business. Good business conditions, or the promise of good conditions, tend to advance security prices, because they indicate larger earnings and a stronger financial condition. Poor business conditions, or an unpromising outlook, have the reverse effect. The larger movements of security prices are always the result of the interaction of these two forces. When they work together, the effect is irresistible, as when low interest rates and the prospect of good business conditions occur together, or when high money rates occur in the face of an indicated falling off in business activity. At such times all classes of securities swing upwards together. However, for the most part, interest rates and business conditions are usually opposed to each other, with rates being low when business is bad, and high when business is good. Usually the worse business conditions become, the easier money grows. While the more active business becomes, the higher money rates rise. The effect of this antagonism between the controlling causes is to produce movements of different proportions and sometimes in different directions in different classes of securities. High-grade bonds may be declining, middle-grade bonds remaining stationary, and poor bonds advancing, all at the same time. This serves to give a very irregular appearance to the security markets, and appears to justify the opinion that security prices can be a pure matter of guesswork, and that they are controlled only by manipulation and special influences. A clear conception of the nature of the influences which are always silently at work reconciles these apparent inconsistencies, and makes it plain that general price movements are determined by laws as certain as the laws of nature. This may be illustrated by a single example. Let's assume that interest rates are low and business conditions bad, with the prospect of still lower interest rates and still more unpromising business conditions. What will be the effect upon different classes of securities? High-grade bonds, such as municipals, whose safety cannot be greatly impaired by a slump in business, will advance, because their market price is influenced almost wholly by interest rates. If their interest is certain to be paid, no matter what business conditions may become, they cannot be greatly affected by a reduction of earnings, and consequently, the influence of low interest rates is left to act practically by itself. Up to this point, we have been concerned merely in showing that the market movements of negotiable securities are controlled by the influence of certain factors. A more important question now remains to be considered, namely, whether the effect of these two influences is to produce general swings in prices which may be depended upon with comparative certainty, and, if so, what indications are afforded to the investor at the beginning or end of such a movement. The answer must be that the combined effect of the two influences is to produce definite and regular swings in prices, and the indications which define the movements are not difficult to follow. A general survey of the history of every single nation reveals the fact that business conditions undergo alternate periods of prosperity and depression, extending in clearly defined cycles of substantially uniform length. By tracing the usual course of interest rates and of business conditions throughout one of these cycles, a general idea can be formed of the way in which the joint influences operate to produce price movements. I won't attempt to estimate here the extent to which the variation of interest rates impacts upon changing business conditions, but will be content to note carefully the general course which interest rates go through cycles. Immediately after a financial crisis, which usually comes after a period of business prosperity, interest rates can become abnormally low. Within a few months from the end of the crisis, money accumulates in enormous volume in financial centers. This is caused by a decrease of business activity, which renders unnecessary a large part of the circulating money that was formerly needed to transact a greater volume of business. However, as time passes and economies in operation begin to appear, and especially as waste and extravagance are controlled, a country as a whole commences to accumulate more real liquid capital. That is to say, its total economic production leaves a surplus of money over the amount of consumption. In this state of business activity, the surplus wealth created finds its way into bank deposits as liquid capital. The competitive attempt to loan this money at a time when there are few borrowers creates very low interest rates. This continues for some time, and it only gradually improves as confidence returns and as the spirit of initiative begins to reassert itself. Here and there, some enterprising groups of people will develop a new business venture, or make some addition to an existing business venture. However, for some length of time, the liquid capital of the country not only remains unimpaired, but continually increases. After a time, a change comes. The annual surplus of production, although larger than before, is only sufficient to provide for the new undertakings which the growing optimism demands. Interest rates rise moderately in response to the added demand for capital. A few years further along, as business activity increases and success appears plainly to wait upon new ventures, the demand for new capital with which to develop increased facilities and new enterprises exceeds the annual supply of wealth created. Prosperity having increased, another factor asserts itself. The spirit of economy and thrift which had prevailed throughout the years of recession gives place to extravagance and the demand for luxuries. While the total production is much greater than in the lean years, the margin of production is not proportionately as great, and this amount is insufficient to meet the demands upon it. The supplies of liquid capital stored up during the years of recession are restored, and they serve to provide the new capital for a few additional years. Interest rates then reflect the change in stored-up capital, and in this case, they begin to rise. The foregoing is a description of the more important stages through which business conditions pass from crisis to crisis. Different cycles, of course, vary in particular details, but all agree in these essential factors. Sometimes special influences are at work which operate to shorten or prolong the cycle. The approach of a crisis will be retarded by inflation, because the excess money finds its way into bank vaults and increases the volume of loanable credit. On the other hand, the approach of a crisis can be greatly hastened by war, natural disasters, and by attacks upon capital and the conduct of corporate business, for such attacks tend to restrict capital expenditure and produce the same effect as a violent curtailment of the supply. These are only some of the many influences which might become operative, but they serve to show the necessity for careful consideration of all the factors at work, if a true conception of the condition and tendencies of business is to be formed. From the general account given above of the successive phases of a credit cycle, it is possible to summarize the course of interest rates and the course of business conditions. Interest rates become suddenly low after a crisis, remain low or grow easier for a period of several years, and then rise continuously until the next crisis, advancing with great rapidity toward the close of the cycle. Emerging from the strain of the crisis at their lowest point, high-grade bonds, such as the best municipal and corporate bonds, grow in value rapidly as interest rates decline, continuing their advancing tendency throughout the period of recession which follows upon the heels of an economic crisis. As business conditions improve, their position, while perfectly secure before, is further strengthened and an added stimulus is given to their rise. About the middle of the cycle, when the business outlook is very promising and before interest rates have sustained any material advance, the prices of high-grade bonds are usually at their highest point. From that time forward they start to decline, in spite of the increasing prosperity of the country, under the influence of rising interest rates. They make their lowest prices in the midst of the crisis, when the strain upon capital is greatest and the outlook for business most unpromising. The lowest grade of bonds, like junk bonds, do not start to recover materially in price, in spite of the influence of low interest rates during the hard times which follow an economic crisis, with the influence of reduced earnings and the fear of default of interest holding them in check. As the outlook becomes brighter, they advance rapidly and continue to improve in price, as long as they yield more than current interest rates. At some point toward the end of the cycle, they reach their high point, and thereafter, decline under the influence of the growing restrictions in the economy. Every class of security or stocks can be found between these two extremes. The better ones will tend to resemble, in their market movements, the course pursued by choice bonds. The poorer ones will approximate junk bonds. However, in every case, unless special influences operate to produce variations, the market swing of a given security may be easily speculated by an investor who gives careful attention to the relative weight which is likely to attach to each determining influence.